In May 2025, the Indian military initiated Operation Sindoor, executing precision airstrikes on terrorist sites across the line of control. The immediate response was a transition in modern combat, an escalation into asymmetric drone warfare across Indian airspace. This data captures the immediate financial fallout. On the left, the Nifty 50 index on the day of the strikes. It dipped a mere 0.3% at the open and fully recovered by the afternoon. The equity markets absorbed the geopolitical shock with little resistance. On the right side of this chart is the state's structural reaction. In the 2026-27 union budget, the Ministry of Defense allocation reaches a record 7.84 lakh crore rupees. While the markets treated the border conflict as transient, the government is pricing in long-term escalation. That military spending is just one fraction of a wider expansion. Over the next fiscal year, the central government is preparing to disburse a total of 53.47 lakh crore rupees. Within that total figure, capital expenditure, the funding deployed for hard physical assets and infrastructure, is jumping 11.5% year over year. Here is the mathematical paradox at the center of this budget. Despite financing a massive defense buildup and expanding infrastructure, the government projects its fiscal deficit will actually shrink to 4.3% of total GDP. To understand how the state is executing this contraction while spending more, we have to trace the exact flow of capital through the government's balance sheet. New Delhi is attempting a delicate balance. They are funding modern warfare and domestic heavy infrastructure simultaneously, without triggering a sovereign debt crisis at home. This flowchart models the 2026-27 union budget. On the left, inputs, tax, non-tax revenue, and borrowing. On the right, outputs show where capital is deployed. Focusing here, we isolate the largest operational allocation, the Ministry of Defense, absorbing 15% of all central spending. That concentration of capital connects directly back to the asymmetric drone warfare and border posturing initiated in early 2025. Drilling into the defense numbers reveals a 17.6% surge dedicated specifically to capital outlay. The military is prioritizing hard assets, fighter jets, missile systems, and secure infrastructure over recurring maintenance costs. But liquidity is constrained by committed expenditure, bills paid before buying new assets. Shifting focus, we find the primary structural drag, interest payments. Servicing the national debt consumes 14.03 lakh crore rupees, representing 26% of total expenditure flow. To frame the severity of that debt burden, those interest payments devour 40% of all the incoming revenue receipts the government collects. Maintaining an aggressive defense posture under that kind of debt pressure requires ruthless trade-offs elsewhere in the budget. We can see this mechanical balancing act in the urban infrastructure allocations. The government has authorized a massive 179% increase for the Pradhan Mantri Awas Yojana urban housing scheme. To afford that spike in urban development without increasing the deficit, capital is pulled from rural support. Specifically, the agricultural fertilizer subsidy has been targeted for an 8.4% reduction. By trimming recurring rural subsidies, the state manufactures the exact liquidity needed to finance its defense modernization and urban capital expenditures. The expenditure profile represents a strict pivot away from rural welfare growth, redirecting that capital straight into hard infrastructure and militarization. Now we pivot to the inputs. If the state is increasing total spending by 7.7% while shrinking the deficit, where is the liquidity coming from? This table breaks down the central government's projected receipts. Looking at the gross tax revenue line, the government expects overall tax collections to grow by a baseline of 8%. However, that 8% average masks a divergence. The state relies heavily on direct taxes. Looking specifically at the rows below, the projections are highly aggressive. The government expects corporation tax to jump 11% and personal income tax to rise by 11.7%. To legally extract that required liquidity from the private sector, the finance bill implemented specific regulatory adjustments. They increased the securities transaction tax rates on both financial options and futures, directly tapping into the daily trading volume of the markets. They also introduced a mandate taxing all share buybacks as capital gains, trapping corporate liquidity and forcing companies to pay a premium to return capital to their promoters. But the highest risk variable in the government's funding model isn't tax collection, it resides in capital receipts. The budget sets an ambitious target of 80,000 crore rupees from disinvestment, the privatization and selling off of state-owned assets. This chart detailing historic disinvestments illustrates why that figure is a major red flag. Notice the consistent gap between the gray bars showing budget estimates and the yellow bars representing actual completed sales. For 5 consecutive years, the government missed its privatization targets and subsequently lowered its expectations. This budget marks the first time they have reversed course and actively increased the target. Achieving a 4.3% fiscal deficit relies on a narrow tolerance for error. If the aggressive direct tax yields fall short, or if the asset sales fail to materialize, the government will be mathematically forced to borrow more to cover the spread. There is one final structural mechanism determining how state capital is deployed: the divisible pool. Before the central government can spend its tax revenue, it is legally required to transfer 15.26 lakh crore rupees back to the individual states. This table outlines the exact criteria for dividing money among regional economies. The baseline equity metric remains income distance at 42.5%. However, looking below reveals a structural change. The metric rewarding efficient tax collection has been completely eliminated. In its place, the Commission introduced an aggressive new metric. The right-hand column of the table shows this new contribution to GDP parameter has been assigned a 10% weight in the distribution formula. The central government is abandoning rewards for mere administrative tax efficiency. Instead, it is rewiring federal capital to reward the specific states that act as the primary engines for national GDP growth. We have deconstructed the budget model. India is operating as a high-velocity state, absorbing external military shocks through targeted defense capex, while enforcing a strict fiscal diet domestically. Hitting the 4.3% deficit target is mathematically possible, but practically brittle. It relies entirely on the private sector and aggressive asset sales to cover the spread. This chart of outstanding liabilities reveals the long-term goal forcing this fiscal consolidation. Following the downward slope from its 61% peak in 2020, we see the true trajectory. The government is driving liabilities down to 50% of GDP by 2031. Financing a military buildup and national infrastructure without triggering a sovereign debt spiral requires extracting maximum efficiency from both capital markets and state-level economies. Over the next 5 years, that efficiency will determine if India can sustain its dual goals of security and growth.